Welcome back to the desk. John O.J. here. Gold just moved $110 in a single session, and two of the biggest macro forces of 2026 collided in the same 24-hour window to make it happen. If you don't understand what just changed and why the $59,100 question is suddenly back on the table, you're going to be reading headlines instead of understanding markets. Let me show you exactly what happened, why it matters, and what comes next. If you're tracking this with me, comment OJ signal below. That's how I know the desk is locked in. On February 20th, the Supreme Court issued a 6-3 ruling that struck down the Trump administration's global tariffs under IEEPA, the International Emergency Economic Powers Act. The court found the executive had exceeded its statutory authority. Decades of tariff assumptions, built into supply chains and trade relationships around the world, were invalidated in a single afternoon. The White House called it terrible. Within hours, the administration responded with a new 10% global tariff, a 150-day emergency measure while the legal picture gets sorted out. That same window saw U.S.-Iran nuclear talks in Geneva stall completely. No progress on nuclear thresholds, no movement on sanctions, no agreement on missiles. The U.S. has a second carrier group positioned in the region, 50-plus aircraft on standby. President Trump warned publicly that without a deal, bad things would follow. Iranian Foreign Minister Araghchi acknowledged that guiding principles had been discussed. The White House described this situation as impasse. Two events. One legal earthquake under global trade, one geopolitical standoff with real military infrastructure behind it. Both broke open in the same 24-hour period. Gold's response was spot price surging to $5,106 to $5,121 per ounce, a gain of $110 to $119 depending on the source, a single session move of more than 2.3%. This is not noise, this is a signal. There are three forces driving this move simultaneously. Understand all three and you'll understand why this move has legs. Understand only one and you'll get the direction right, but miss the magnitude. Force one is the tariff legal vacuum. The SCOTUS ruling didn't just throw out existing tariffs. It created institutional uncertainty about the executive branch's authority over trade policy entirely. Markets hate legal vacuums. When the legal basis for tariff policy is contested at the Supreme Court level, every supply chain, every import cost calculation, every earnings model built on existing trade assumptions becomes temporarily unstable. That instability has a historical home. It's gold. The new 10% global tariff doesn't resolve the uncertainty. It extends it for 150 days. The market is pricing in a prolonged period of trade policy ambiguity. That suppresses confidence in the dollar's role as a stable store of value. Look at 2018 to 2019. Every escalation in tariff uncertainty, every time the legal and policy ground shifted, gold found a bid. This is the same dynamic, but the constitutional stakes are higher. Force 2 is the Iran military clock. The Geneva impasse is not a diplomatic inconvenience. It is a countdown. A second U.S. carrier group doesn't deploy as a gesture. 50-plus aircraft on standby doesn't happen to add color to a press release. The infrastructure of a potential strike is in place. The timeline is contingent on whether talks produce movement. Right now they aren't. The 1979 Iranian Revolution drove gold up more than 160% over 2 years. The 2024 Israel-Iran exchange produced intraday moves of around 1%. Smaller, but immediate. What's different now is the explicit U.S. military posture and the stated consequence of failure coming directly from the president. The safe haven premium is being priced in now because the window for resolution is visibly narrowing. Force 3 is the economic data turning dovish, and this is the one most commentary missed. U.S. Q4 2025 GDP came in at plus 1.4% annualized. The consensus was plus 3.0%. Q3 had printed plus 4.4%. That's not a deceleration. That's a cliff edge in a single quarter. The February 2026 Flash Composite PMI came in at 52.3, the lowest since April 2025. Manufacturing hit 51.2, a 7-month low. Weak GDP and weak PMI tell the Federal Reserve to cut. CME FedWatch data reflected approximately 85% probability of a 25 basis point cut at the March 2026 meeting. Total 2026 cuts being priced at 75 to 100 basis points. When the Fed cuts, real yields compress. When real yields fall, the opportunity cost of holding gold disappears. That's the mechanical relationship that has driven every major gold bull cycle in the modern era. The data this week didn't just support that narrative, and it accelerated it. Three forces converged in 24 hours. Tariff legal chaos suppressing dollar confidence. Active Middle East military tension demanding safe haven allocation. Weakening economic data signaling a dovish Fed. Each one individually moves gold. All three together explain a $110 single session move. Now let me address the $5,900 question directly. Goldman Sachs is at $5,400 for end 2026. UBS revised to $6,200. Wells Fargo is in the $6,100 to $6,300 range. Deutsche Bank at $6,000. JP Morgan at $555 for Q4 2026, with longer-term targets significantly higher. These are not retail forecasts. These are firms with commodity desk infrastructure and decades of price model history. When they revise targets upward in a single cycle, they're recalibrating structural models, not reacting to a news event. 2 days before the SCOTUS ruling, gold was near $4,180. By February 21st, it's above $5,100, a 2-day gain of approximately 4.5%. The September 11th safe haven move, for comparison, was roughly 5% to 7% over several days. We covered 4.5% in under 48 hours. The fundamental case for $5,900 is not the question. The question is whether the catalysts sustain or resolve. Right now, neither the Iran talks nor the tariff legal situation shows any sign of near-term resolution. Here are the 3 scenarios. I'll give you the structure. Assign your own conviction. Scenario 1 is the escalation rally, 50% probability. Iran talks collapse. Military posture becomes action. Tariff legal uncertainty extends as challenges to the new 10% stopgap mount. The Fed delivers the March cut. Real yields fall below 1.75%. The dollar weakens. Gold breaks $5,200, tests $5,500, and the institutional targets in the $5,900 range come into play within weeks rather than quarters. This is what the current tape is partially pricing. A 2% single session move reflects real probability of escalation, not just acknowledgement of the possibility. Scenario 2 is the volatile trap. 30% probability. Iran talks resume under a narrower framework. The 150-day tariff window is used to negotiate alternative trade agreements, and markets begin pricing stabilization rather than chaos. The Fed still cuts, but safe haven premium compresses as geopolitical risk fades. Gold consolidates between $4,900 and $5,200. In this scenario, buyers who chase the breakout above $5,100 on thin weekend liquidity find themselves in a whipsaw. Direction right, entry wrong. Scenario 3 is the breakdown reversal, 20% probability. A framework agreement on Iran is announced. Congress uses the SCOTUS ruling as a trigger to pass permanent tariff legislation, removing the uncertainty. GDP data revises higher. The Fed holds in March. Real yields stabilize. Gold falls toward $4,800 as both the safe haven and dovish Fed premiums unwind. This is the lowest probability for one reason. The military infrastructure already deployed doesn't demobilize overnight, even with a diplomatic announcement. That residual risk keeps some premium in place regardless. Here's exactly what to watch, in order of importance. The Iran timeline is the primary driver. Watch for any formal announcement of resumed talks. That's the signal for scenario 2. Watch for additional carrier movements, explicit strike authorization language, or any escalation in military posture. Now that's scenario 1 accelerating. On tariffs, the 10% countermeasure will face immediate legal challenges. If a court issues a stay, uncertainty compounds. If Congress moves to codify tariff authority legislatively, uncertainty begins to resolve. Both paths have a direct gold implication. On the Fed, watch for any official commentary referencing the Q4 GDP miss. A plus 1.4% print against a plus 3.0% expectation is not a rounding error. If Fed officials shift their language from patient to attentive, real yields fall and gold finds another leg. On price levels, $5,200 is the next meaningful resistance. A clean close above it on normal liquidity, not a thin weekend gap, changes the technical picture and puts $5,500 in realistic near-term view. On the downside, $4,900 is critical support. A close below it on full market participation weakens the bullish case materially. Watch DXY. A sustained move toward 96 or below confirms dollar weakness is contributing to the bid. Real tips yields falling below 1.75% confirms the dovish Fed thesis is gaining traction. Both signals together is the setup for scenario 1 to play out in full. Now the bigger picture, because single session moves distort perspective if you let them. Gold at $5,100 is not a surprise to anyone tracking the structural case. U.S. debt to GDP at 125%. Annual interest payments now exceeding $1 trillion. Fiscal deficits projected at $2 trillion per year. Central banks, led by the People's Bank of China, across 15 consecutive months of purchases, buying at a pace that reflects strategic diversification away from dollar assets, not tactical allocation. These are not catalysts. These are foundations. The tariff ruling and the Iran standoff are catalysts. They accelerate moves. The structural foundations have been preparing for months. Structures set the direction. Catalysts set the speed. Three independent catalysts fired simultaneously on top of a structural gold bull case that Goldman, UBS, and Wells Fargo had already incorporated into multi-thousand-dollar price targets. When catalysts align with structure, the moves are neither traps nor anomalies, they're confirmation. That doesn't mean the path is straight. A 30% probability scenario for a volatile trap is not negligible. Markets run head fakes in both directions. Weekend liquidity on February 21st was not deep, and a $110 move in thin conditions always carries partial reversal risk when full institutional participation returns. But here's the honest raid. The three forces that drove this move have not resolved. The Supreme Court ruling stands. The Iran talks remain stalled. The GDP miss doesn't revise away. Until one of those changes, the bid under gold is structural, not speculative. The Supreme Court handed markets a legal earthquake on February 20th. The Geneva talks handed them a geopolitical countdown. The Q4 GDP data handed them the dovish Fed case. All three hit in the same 24-hour window. Gold answered with $110. The question is not whether gold belongs at $5,100. It's already there. The question is whether the conditions that put it there persist long enough to test the $5,500 to $5,900 range that institutions have been pricing into their forward models for months. Watch the Iran timeline. Watch the tariff legal process. Watch real yields. Those three signals will tell you which scenario is playing out. Not the daily price tape, not the sentiment headlines. This market rewards preparation, not reaction. Do your own due diligence. Understand the risks. The structural case does not guarantee the timing, and in markets where a Supreme Court ruling and an Iran impasse can both land in the same session, the timing can change fast. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. John O.J. out.